First up, some of the best returns an investment manager can generate are from buying great companies that are facing some short-term headwinds. Toyota Motor Corporation was facing all sorts of trouble a little over 2 years ago when issues surfaced regarding sticky accelerator pads. It took a while for the company to sort out the problem, but investors have been handsomely rewarded since then. Nic Norman-Smith from Lentus Asset Management joins us in studio to take us through the story. So Nick, I think we're all very familiar with what happened. It was documented, locally on our I think Carte Blanche even did an expose on it. They had the sticky accelerator pads. There was rumors that a family had died in America because of it. Lots of bad news around the stock. Was that the time you started getting involved and looking at Toyota as an investment case?
Yeah, thanks, Warren. It was. We at Lentus, we like to look for bad news stories because we love buying great companies, but unfortunately, generally the world and the market knows when a great company is such, and therefore it's priced for that. And obviously, if the pricing is correct, there's very little return that you can generate. So when you get a great business like Toyota undergoing some short-term headwinds, we get really excited. So there was the sticky accelerator pedals, as you mentioned. There's been the incredibly strong yen, which, as we know, in South Africa is very, very tough for exporters. Toyota exports a large amount of their vehicles out of Japan. There were floods, there was tsunamis. So this company had, it obviously sells a lot of cars into America, which went through the global financial crisis. So everything that could possibly go wrong with this business did go wrong. And what that meant was that from a fundamental basis, you could buy this company just two odd years ago at book value. So what we're saying here is that the greatest auto manufacturer in the world, which has a production system that has been copied, millions of books, lots of books have been written about it. You could get all of that for free. You were basically buying the assets of the business and getting the brand and all of those processes for free. We thought that was a fantastic opportunity, and we built large positions in our client portfolios. And interestingly enough, the company did not much. For a couple of years, the share prices wavered along because just as it was about to recover, the next headwind hit.
By something else.
And it just shows, I think, you need to be patient because it seemed like, well, you're buying this company at book, this is a no-brainer. But after sitting in it for a couple of years and getting very little return, you start to question yourself.
Just in terms of making that call, though, I mean, that was a great story because there was so much public apprehension. We had this family that was driving a Toyota. Something went wrong. They all died. So it had a lot of really ugly news to it. But with regards to the accelerator pad, I mean, you can't possibly know at the time if that's a long-term change in the way that the company manufactures vehicles. Perhaps the quality in the manufacturing plants had vastly come down, and this was a sort of symbol of that happening. So how do you think about it? Do you sort of take a little bite at the stock and then see how it goes? And if you see that the worst case scenario happens in the event of poorer quality vehicles coming out of their production line, then you kind of sell off? Or how do you treat it within the portfolio as you make that decision?
Yeah, it's a good question. One needs to look and say, is this a short-term issue or is this business fundamentally broken? All businesses go through some tough periods. So yes, clearly there were some management issues and they had let their quality fall apart. But that's not something that fundamentally can't be fixed. The brand is still very, very strong. Of course, there's always a concern about, there's this legal liability that no one knows what it is. But history's shown us that generally concerns around stocks and legal liabilities tend to push the share price lower. So the settlements are never as bad as one thinks from a shareholder perspective. It's similar to BP, which is another business that we own. Again, because there are big concerns about legal liabilities. So yes, one never knows what the future is going to hold, but the odds were with Toyota. This is still a great brand, a great production process, and we all know what litigation is like in the US. These things blow up. As you mentioned, it's a very emotive issue. People are concerned, people are dying, but as an investor, one needs to, as callous as it sounds, take a step back and say, look, what are the hard facts? Every business is going to get sued every now and then for some mistakes that they make. In fact, after all of this, Toyota was never found to actually be guilty anyway. A lot of those sticky accelerators were driver error. So yes, one never knows, but again, by paying book value for this business, we think your downside was limited to quite a large extent.
You mentioned BP there, and that's another great story, and one that has, I guess, a much more open-ended liability than Toyota had with what appeared to be a problem, and it, as you correctly say, it turned out it wasn't that way. BP's case, was that a company you've invested in?
It is. So we, interestingly, we avoided it, and there was the initial concerns, and we really didn't know what this liability was going to be like, and the well was still getting, it hadn't been plugged yet, and we were a little bit nervous then. The stock then rallied up, got a little bit expensive, and then came back again as the news sort of filtered through. So we actually felt the second bite at the cherry. We now had a much, we knew how many barrels of oil had gone out there. You could estimate and get an idea of just how bad the liability could be. And we thought actually at a slightly higher price, you are now getting BP with much more certainty. Yes, we still don't know what the exact legal liability is, but you go and look back at the tobacco companies that had massive concerns a number of years ago, and a lot of the pharmaceutical companies. And history shows you time and again, the liability is always less than the market expects, because what investors tend to do is look at the here and now and go, wow, I'm not touching this. I'm very, very scared. This company is doomed. And in a couple of years, people have forgotten of that. It's going to take years for the money to be paid out. And BP is still generating significant cash flows. And if you value the underlying assets, the oil that it owns in the ground, it's trading at a significant discount per barrel to all of its competitors.
So still at this time, BP offers value. And in terms of the valuation, how badly did it get hit after the Horizon oil spill?
Look, I'm trying to think exactly how high it got to, but it was probably certainly off around 50% off its highs. So the ADR went down. It went all the way down to around $30, and now it's trading at around 40 odd, and it's sort of been bouncing around that level. And it's actually what's happened is it sold off a number of assets which it had to do, and actually got much better prices than the market was expecting. So it's in a stronger shape than it was before. It's got the uncertainty with this liability, but they've settled a lot of these liabilities, and as unfortunately these bank companies do, if you want to look at it from an ethical point of view, they tend, they've got the money and the resources to fight these things and to live another day.
Now, as a value investor, I know you look for these situations. Yeah, I'm sure you go out and look for them. I've got to ask you at this point around the platinum industry in South Africa, the perfect storm over the last 3 years. Everything that could go wrong has gone wrong. Is platinum on your radar at this point?
It is. We are investors in Amplats on behalf of our clients, so it absolutely is. And it is quite similar in a lot of ways for Toyota. The industry's in turmoil. South African mining in particular is in turmoil. As you say, everything that could go wrong has gone wrong. We've seen more issues in the last couple of days. So yes, once again, what are you doing? You're buying these companies, well, not quite at book value, but certainly at the lowest price to book valuations that we've seen in a number of years. So the question is, are these businesses fundamentally broken? We don't believe so, and if that's the case, well, at these valuations, we think the dust will eventually settle. The sooner the better for everyone, but we think it will have a positive outcome for investors.
Now, I'm just interested, and I always ask this question because I always try and understand why we have these discounts that exist in the market. And unlike overseas, where a large component of the shareholder base in a BP or in some of these other companies are retail investors, by far the large majority in South Africa are professional fund managers like yourself that own these stocks. Why do these share prices get beaten down so badly by the likes of professional investment managers? Do you have any insight on why these valuations come about?
From a value investor perspective, the hardest thing for us to do is that it's not fun to tell your mates that you're invested in a fund or you directly invested in platinum, and that you're not invested in retailers. So psychologically, it's very, very tough, because as always, if we're wrong together, the herd is wrong, it's not so bad. So you know what, if you lost a lot of money investing in Citigroup over the US crisis, well, that happened to everyone. People feel quite comfortable about it. But if you go out on a limb and you're wrong, you look really, really stupid. And that's the case with a lot of these value stocks. You say, what the heck am I doing being invested in platinum? Don't you know the industry's in turmoil, costs are going up, How could you possibly do that? How could you be invested in Toyota? Everyone knows the Japanese economy is in deflation. No one is buying cars in the US anymore. They've had all of these recall issues. So the story is very, very hard to tell. And sometimes, as we saw with Toyota, you need to wait a year or two or more for the story to come out. And the patience of sitting through that can become too tough for a lot of investors to handle, and then you get pushed out of the situation. So as a value manager, there's kind of two things. It's one, managing the investments, and two, it's managing your clients. If you can have clients who are willing to sit through this because they know what you're ultimately trying to achieve, and that becomes, as you build a relationship with your investor, it becomes easier because we can look back now. So we can say to our clients when we invest in platinum, well, remember how scared you were when you were in Toyota? Well, you see it came through. And as you build a track record, people start understanding it. But unfortunately, it's a very counterintuitive investment style. And that's why, 60 years after Ben Graham and David Dodd wrote their books, this is still a very, very good way to generate long-term returns.
Okay. Before we run out of time here, you've also you've been doing some work around some of the retailers, particularly in the UK. You've identified Tesco and Sainsbury and just compared them to the valuation of our local retailers. Just take us through what you see in those two UK retailers.
Okay, so these are great businesses. Once again, who would want to invest in the UK and Europe? We all know how terrible the story is. But if you look at the fundamental valuations, Tesco is trading at just above book value. It's got a property portfolio alone, which is worth a significant amount of their market cap. It's on a price to earnings ratio of 10 and a 5% dividend yield. Let's compare that to ShopRite, which even after today's results is on a PE well north of 20, price to book of 8 times, and dividend yield of around 2%. And why is that the case? Because 10 years ago, it was almost exactly reversed, incidentally. Everyone wanted to be in Tesco because emerging markets were very scary places. No one wanted to touch them, and the developed market was the safe place. We've had a complete switch now, and taking nothing away from how well ShopRite and all of these retailers have done. And we've heard these stories many times from a lot of us who've avoided these retailers and they've carried on going up. But the reality is, when you pay the kind of premiums you do for South African retailers right now, you're generally going to do very, very poorly. And just the same, yes, it's clearly quite a tough time for the UK retailers. A business like Tesco, which incidentally has 60% UK exposure and 40% very exciting emerging market growth in Asia, probably one of the best run, well, definitely one of the best run retailers in the world other than Walmart. At this kind of valuation, it just shows how negative people are towards Europe. And once again, we believe at these valuations, the downside risk is taken care of. And if things look just a little bit better in the UK and Europe, you could see a significant re-rating of these businesses.